At IB Canada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
As Nelson Nash said, the author of Infinite Banking, the Becoming Your Own Banker, if you're not aware of the problem, you're never going to seek the solution. So if we're all learning from the same course material, but that course material is wrong right from the very beginning, then all we're doing is repeating over and over again the same problem, but nobody realizes it. We do RSPs now because we don't like tax. Well, the problem is we're just growing a larger amount of taxable harvest in the future. So if we don't like paying tax now, we're definitely not going to like the tax bill that's going to happen when we get to retirement.
No, and a lot of people are having to swallow that bitter pill right now, right? I've got clients who are thinking, oh, you know what, I need to go spend this extra for this repair, or I need this for that. And when they realize what actualizing those dollars in their hands is actually going to cost them as far as withdrawals, well, they're fighting that, right? But, at this stage, for them, there's not much of a correction. So going forward, part of our huge commitment is to help people to do things in a more beneficial way for themselves. But of course, we have to alert them to what the problem is, even though most of them don't see it right now.
And for all of us, it's that transferring of that money away. That 90% of the after-tax income that comes into our hands. If we are lucky, 10% of that money is saved for a future. The other 90% of it just is lost under what we are told to believe are lifestyle expenses, right? We've got interest, debt consumption, we've got lifestyle, and we have taxes. And if you look at anybody doing a mortgage now, and you've got total or gross debt servicing ratios, people buying homes now, just the house, the interest cost on the house, they're looking at between 35 to 40% total debt servicing ratio. That's money that's going away. And if there was an opportunity for us to be able to start to recapture money in those three pools, then you're going to have a whole lot more money for you in the future. And you're going to be less reliant on having to borrow money from the bank and pay them interest, when you're going to be able to have your own banking system set up where you can borrow from yourself and earn the interest. So we've got a couple of great slides that we want to go through and walk you through what that looks like.
So hi guys, so we're going to look at some slides here because we find that pictures really drive home a point, right? So we've talked about the problem. The problem is all these funds that we are transferring away that benefits someone else as opposed to us, right? So the tap represents our income. We've got income coming in, going into a bucket, right? That's what we made. But we've got holes in that bucket. And that holes are things like taxes. We've got debt, and we've got interest to service that debt, right? And by transferring that away, that is actually our opportunity cost going out the window, right? So taxes and debt and interest really reduces our opportunity cost. So when that happens, that means whoever is getting most of that money now has the opportunity. We have the cost, they have the opportunity. So what we're going to try and do is we're going to show you how to find ways to plug the holes in that bucket. So rather than have an opportunity cost, we now have the opportunity to use those funds for ourselves, right? So we've got, as you can see, a sealed up bucket here, which makes the water flow go higher. So we've got more control over more of our funds. And Hayden's going to go into some details of a typical situation. So take it away, Hayden.
Yeah, so we'll just do a quick example. We'll just do a couple. So the current age of the couple is 30 years old. Retirement age is pretty standard at 65. Current combined income is 140,000, and the income growth is at 3%. And then the current savings and investment return we're keeping at 0, just because we want to just to look at the income alone. So we'll calculate that. And at retirement age, your income potential will be $8.5 million. And the word potential is key, because we'll look at later another slide saying that you don't get the whole 8.5 because of the opportunity cost that flows away from us. So we'll go to the next slide. And as you can see, you have your full $8.5 million throughout your wealth accumulation phases of your life. Now, there's things on the top left category of taxes. So you have provincial tax, federal tax, gas tax, all the things like that. So combined, you're looking at 45%. Debt services like credit cards, you're looking at 20%. And we're always taught to save 10% of your money. So then that leaves 25% to lifestyle. So we'll apply those changes, and the graph will show that we have savings of $850,000. So that $7.6 million is lost opportunity cost of what we could have made on that money or recaptured it. Now, what we're talking about today is IBC and how to use it. So IBC is the tool that can help you recapture some of this opportunity cost. So let's say, just an example, we knock down 3% of each category. So taxes would be 42, debt services 17, and lifestyle would be 22. So just with the tool of IBC, we're now almost doubling our savings, and that's not including putting additional income more, getting a new job. This is just implementing IBC. So we'll apply those changes. And now, as you see the savings down below, we've now doubled our savings without doing anything, without making more money, just recapturing a few percentages of those monies that go away from opportunity cost. So we'll go to the next slide and just reiterate. Glenn will reiterate the bucket.
Thanks, Hayden. So as Hayden just demonstrated, by reallocating some of that cash flow, again, there was no increased income, it's just reallocating what's already being spent and having some of that flow back to us, increase the savings by almost double by doing that. And can we shave off a few points off of taxes by reallocating? Definitely. Lifestyle and debt servicing, definitely. And we've got other videos that'll go into depth on that. But again, for this video and for this visual, taxes, debt, and interest, by plugging those holes or reducing the flow of what goes out, gives us more opportunity. So rather than costing us. And Scott's going to go into another example of that as we go ahead, because like we said, we want to seal up that bucket, keep as much possible to ourselves. And even if we can't seal it completely, plug a few holes, we'll still have the same net result, more income for us, more opportunity for us, rather than having it cost us.
And this is what's really important about people not understanding, or at least not being aware of what they don't know. And once again, if you're not aware that you have a problem, you're never going to look for the solution. What we're trying to bring to you here is to allow you to understand that you have a problem with the way that money is coming in through the front door, flowing through your hands. You're making a conscious decision as to what to do with that money based upon what you've been taught. But unfortunately, that teaching has you transferring 90+% of that money right back out again. So we are not saying don't spend what you spend. We're not saying don't buy the house that you're buying. We're saying when that money comes in the front door, it has to land in somebody's bank account first. And that is a bank account that has your name on it, but you don't profit from it. We want you to have that money stored in a warehouse of wealth that you control, you get to profit from. And because you've capitalized those expenses in the first place, you now get to recapture the lost opportunity costs that we just showed are in the millions and millions of dollars. And as Hayden had talked about, we're not talking about you going out and getting another job and increasing the flow, which would just increase the amount of money that's being lost. We're showing you how to patch up those leaks in your financial plumbing by being able to recapture those lost opportunity costs. So when we talk about any of those expenses, we have one option, and that is to be a debtor, where we now borrow the money from somebody else, another institution, which, by the way, has essentially implemented a process of infinite banking where they have the capital in the first place that they are willing to lend out to you at interest, which means that you now are paying them interest. They get the opportunity cost, but you've now lost that opportunity cost because you're transferring that money away to a separate entity. And if you keep doing that, going into debt, paying it off, going into debt, paying it off, you are transferring away hundreds of thousands, if not millions of dollars to other entities who have put their ducks in a row and capitalized their system in the first place so they could be the lender of first resort. The other group of people are the savers, and they don't want to pay interest or anything, so they build up that money, but then they transfer that money away in exchange for whatever they've purchased. And it ends up being a zero-sum game, just like the spenders. So with infinite banking, we want you to be able to capitalize and put that money into an area where you now get to borrow against it, representing the green line. You have uninterrupted compounding growth of your money while you are now the borrower against that capital. And when you borrow against your capital, you don't interrupt it. So it's like having an apple tree that you plant, and instead of cutting it down to get access to the money, which is what the saver would do, we allow that apple tree to continue to grow just by picking the apples. And over time, that tree, representing your account, is going to grow to a larger and larger amount, giving you greater and greater capital to get access to. So we can start to fund things like vacations, kids' education planning. And we're going to go take a look at that because people love to be able to see what the actual math looks like. So we're going to get into what the math looks like with a lost opportunity cost.
And just before you move on, Scott, just something I wanted to add to that. The three types of savers. We know a lot of people are taught, save up your money, buy what you want, don't owe anybody anything. But the real key is that we're transferring the power of those dollars away when we do that. So even though it's better than the first person who borrows to buy everything, we're transferring away the dollars. So again, first person here borrows to buy everything, just living to get back to zero. The saver, save it up. We're not going to owe anybody anything. It's a better way to be. But by far, the best way is the wealth creator, because you have control of the asset and the funds, and you use somebody else's money, so you control that flow. The opportunity is yours, and that's how we get ahead.
Right, and that green essentially represents the recaptured lost opportunity costs because we started plugging up those holes. So what we're going to look at is, why don't we can just call this, let's just put a title to it. We're going to go vacations, okay? Boom. So now this is our vacation account. Is it true that people go on vacations every single year? Might have changed over the last couple of years with COVID, but now we're going to get back to business as usual. So we have a 30-year-old couple. They're going to go on vacations for the next 35 years. With a family, those vacations are going to become more expensive. So would it be illogical to think that vacations are going to cost probably $10,000 a year for a family of 3 or 4, airfare, hotel, all that?
I wouldn't say so. That's very logical.
So $10,000 a year. And that one vacation, you're going to repeat over and over and over again, correct?
Hopefully.
So then we could say 35 times 10,000 is $350,000.
Yep.
So what we're looking at with infinite banking is, for you to have that $10,000, you could have only afforded to pay one of two ways. You saved up the money and then you depleted the account, which now once that 10,000 is gone, what have we lost? The lost opportunity costs. Or you went into debt, and when you come back from the vacation, you're going to pay that money back. Either way, you still had the money as a saver or as a spender, to pay back or to save up that money on a monthly basis. So if the money was now inside of your specially designed infinite banking account, that $10,000 is there for your vacation, and now we borrow against it, which means that the money never left your system in the first place. And as a result, that $10,000 is going to be able to be kept under your control and will continue to grow for you in the future. So let's be really conservative and let's just put a 3% rate of return on that accumulated money. But now we've just turned that expense into an asset that's going to be there, adding to your retirement bottom line. If we can do this with a vacation, what other expenses do people have?
If I can get that back off one thing, my goodness. Car,
Right.
school, extracurricular activities. Ooh.
Daycare, right? Children's sports activities all year round. You know, hockey can be $5,000, $8,000, $10,000 plus hotel costs and travel and all of that. What we have to understand is that we finance everything we buy. We either pay cash for it and give up the lost opportunity costs, or we go into debt and we pay somebody the interest. And when we borrow the money from somebody else, they did what we're trying to teach you to do. So if we can do this with vacations, we can do this with cars, with income tax, with property tax, with daycare, with grocery bills. All of those holes we get to start to recapture. And it truly is in your control as to how much you're going to be able to recapture based upon working with a specialist like ourselves.
Wow. So you can have your vacations and get back some of that money that would have been gone to transfer it elsewhere.
Right. And if we look at this longer term, I'm just taking it to retirement. Let's add an extra 20 years, so now they pass away at 85. That's $51,000 just from the one column called vacations. Let's do another column called property tax. Let's do another column called, kids' education, right? Private school, Montessori, daycare, all of those. You now start to increase the amount of money you have for retirement into the 6 or 7 figures. And we didn't ask you to change anything other than understand where the money is flowing away from you right now.
Wow. It's pretty mind-blowing when you think of all the possibilities of where this can be applied.
It certainly is. Once you see this, you cannot unsee it. And this is a fundamental shift in how we have been led to believe we need to take on risk assets in order to grow our wealth in the future. Understand, we've taken on no additional risk here. We're not in the stock market. We're not in a taxable account. We're not in an area where your money can possibly lose. As we're shooting this video right now, the stock market has been on a downward spiral, and it's continuing as we see. For all of us implementing infinite banking and all of our clients' assets have only gone up during this period of time and would go up regardless of whether the market was going up or down. So we want a safe warehouse of wealth where you get to recapture your lost opportunity costs and control the whole banking system. This is the way that we do it. This is the way that we educate our clients to do it. And this is the way that we want every Canadian to be able to do it.
IB Canada Group, your independent authority for information on the infinite banking concept.